But today they look at the agri market in India and say, there are lots of inefficiencies here. People don't know, the farmer doesn't know what price he is getting for, what the price consumers buying it. People don't have access to products at low prices, and we can create an agri platform to make it happen, right? But to us, that is only one part of it, because what's very, very important in all of this is domain knowledge, and what we would actually really grill the entrepreneur on and test them is to see whether they really know the situation on the ground. So while IT is the tool to make things happen differently, it doesn't happen overnight. And often the businesses that we find that work best are where you bring in that right balance of domain knowledge, so you know how to get the customer. If it's a farmer, he's not going to tomorrow switch over to ordering everything on his phone and so on. So how do you build the right kind of business which has got a hybrid model, which is that, where you are winning the trust of the customer, so you know exactly what's the on-ground support that you need to provide, but you also have a IT-based model in order to scale that up without needing to keep engaging as much with customers. So that's, one clear thing that we would ask, even for businesses that seem IT-like, but are working on real domains like healthcare, agriculture, or even education. Do you really know the pain point on the ground? The second thing would be that, look, you need to get all these guys, you need to have a proper marketing plan and a strategy, right? And it's not enough if you just have a product. People are not going to come to run to buy it, right? And the third is also that, like was discussed earlier, that some of these businesses may not necessarily be suited to scale dramatically, right? There may be a longer period of adoption, and if you are not a traditional business which can take VC funding, which expects you to grow 10x in 3 years, then you should not probably be taking that kind of funding, right? So is there a proper understanding of what the business itself is like? So these are the sort of 3 questions we would ask, even to businesses for whom IT is a disruptor. But if you don't have the basics of non-IT businesses, then it doesn't work. So in conclusion, I'll just leave you with another thought, that while it may appear that every theme needs to be thought about in terms of IT, I think for our fund, we see a lot of opportunity around 2 larger themes that are playing out in India. And that's the way we try and approach opportunities. And then we look at whether IT is a key enabler, and if so, what's the kind of role it has to play. The first theme is about the fact that consumerism, right? And we see it all around us. But the other dimensions to it is that consumer tastes are changing. There are brands which are growing much faster than they did traditionally. So many of you might have heard of this deodorant brand called Fog, right, which has literally grown to 1,000 crore brand in a very short period of time. Those are opportunities that we see a lot with food and various other consumer products. And we see a lot of opportunities to get to the markets where access has been less, like rural markets. So that's one theme we are playing. The second theme I'd broadly say is that it's about modernization of Indian business, right? And whether it is agriculture, which is actually the largest business that exists in the country in terms of farmers being individual businessmen, SMEs not having access to finance or not having adequate IT-enabled platforms to get efficiency in their businesses. We see that as a big opportunity, right? And this is where, in some cases, IT will play a larger role than others, but at the end of it, we don't want to think about them as IT businesses or non-IT businesses. We want to think about them as the large opportunities that exist around these 2 themes, and where IT plays a role, a significant role, we need to evaluate it against that. So with that, I'll just stop. Thank you.
Thank you for the introductions, and I thought, I'm assuming broadly that this is a congregation of people who are either interested or already currently pursuing non-IT enterprises, and more to, in that sense, understand generally how funding happens, right? So just to sort of give a broad context, right? Keep it out of time. Just to keep a okay. Yeah. Before I think it's worthy to sort of I'll take you through a 4-minute kind of a thing which explains what we do.
With a billion plus population, India represents one of the largest consumer markets in the world, and that really fuels the growth of Indian food industry.
Prime Minister has articulated his vision of doubling farm income in 5 years' time.
India, the logistics and supply chain moving from a traditional trucking and a transportation business to a high-end digitally enabled business.
Few years back, I was always thinking that there is a dearth of angel investment in India startup ecosystem. Today, that gap is filled.
Springforth is an organization that has been created to serve. We are here to serve promoters and industry to unlock their value and potential to their full scale and capability.
We engage and take positions in the early stage companies who need not just money but also mentorship, networking, domain expertise, which is in fact a deep engagement model.
Springforth has put together a very strong operating team with deep operating experience.
New technology like information technology, communication technology, satellite technology, these are providing a lot of opportunity for application in agriculture.
The changing dynamics of the business required high-end logistics and supply chain solutions. The digital disruption in India today required a new set of companies to emerge, where we'll give a lot of mentoring, supporting and domain expertise.
The country has a challenge to feed nutritiously 1.3 billion people today, and that is expected to be 2 billion by year 2050.
And within the food sector, there are multiple verticals. You could look at the QSRs, you have the fine dining restaurants, then you have the cloud kitchens, which are actually fueling the internet first models.
We basically are looking with Springforth in terms of not only investment but also giving us mentoring, networking, and also helping us to take it to the next level.
The sectors in which Springforth is looking to invest are sectors which are undergoing disruption in India, where I think a lot of value will be created over the next few years.
We are about 100 crore fund to be invested in the sectors of agri, food and logistics. Pre-Series A level, the companies with 2 to 3 years of vintage. From a sub-sectoral perspective, while the agri, food and logistics are the verticals, the horizontals become brands and technology.
The system is so broken and so disconnected, and the technology doesn't get to the farmers, and the capital doesn't get to the entrepreneurs because there's nobody to fund them. So that represents a tremendous opportunity for companies like Springforth to focus on the agri-food activities.
The biggest investor value, I believe, is in exit. If you invest appropriately at an early stage and if you exit at a Series A, Series B, then that is the maximum potential at which an investor can get an exit.
Suffer.
Springforth
Agri, food and logistics.
All right. So I thought it would effectively sort of set the tone of what's happening on the other side of non-IT investment, from at least from our perspective and our philosophy. Now, let me start with where I sort of attempted to start this whole discussion. So let's understand a bit of context to why debate such as investing in non-IT sector is something which is coming through. Right, so while a few decades back it was about capital reaching enterprises, now obviously it's been established that it's technology that's driving the enterprises globally, right? So that's a bit of macro global GAN about it. So and hence there is a structural shift which is happening across the sectors. Whatever sector you may talk about, there is an IT intervention, there is a technological intervention, there's automation which is happening. So I think it's beyond doubt that technology is going to pervade across all the sectors as we go forward. So for the sake of the current discussion, let's have a pure play understanding of what we mean when we say IT versus a non-IT, right? So if you take, for example, an IT company, which is, let us say, an IT product or an IT service versus a non-IT, which is not an IT product, IT service, but something which obviously uses technology, because technology today, as a lot of speakers have sort of driven home the point, and I think this is largely an argument or a discussion beaten to death, that in future IT, there's also another way of saying that IT actually going to represent integrity and trust. So if you don't have IT systems in your company, so it's going to become a hygiene over time, as one of the speakers was saying, over 5-6 years later. If we actually talk about IT or a company without IT, it's a hygiene, right? So that's obvious. So I think let us focus on what does non-IT in the context of the definition stand out. Let's compare and contrast what are the fundamental difference between an IT versus a non-IT. See, one of the biggest things in case of a non-IT company is the linearity in terms of right from the word go. Versus, so if you look at a graph, right, so there is one steep step up in case of an IT firm. There is a product, there's a product development, there's something they stumble upon, there's a problem, small or big, which gets which is attempted to be sorted out, and then you then at that point of time hit the linear curve. As against non-IT, which is, for example, an agri-food or a logistics firm, it is the linearity kicks in right from the day one. You need to grow from point A to B to C, where you need to move in a linear fashion in terms of your investments, in terms of. So at some point of time, you'll start figuring out that the funding actually is a working capital funding that you're doing, right? So you take a food, you take an agri. So the question is, what kind of funding is appropriate for a non-IT? I think one of the speakers already touched on that, but we should understand what kind of funding. First of all, do we need an equity funding? If yes, at what stage? One of the way we tried solving the problem around, we as in we all, that whether there can be a technological dimension or a brand dimension into it, that's where potential disruption can happen in some of these sectors. So it grows to a certain point, then it reaches a tipping point, escape velocity, whatever we call it. And then that's the point at which it is possible that there is a potential next orbit one moves into. Why is that important? That's important because that's how investors think. And we are discussing this in the context of what kind of funding. So if you're talking about an equity investment, let's say a VC or a private equity investment, it's extremely important. Of course, there are other alternatives. I would say really better alternatives, like what Sanjay is, for example, handling, like the family offices, and who have got fairly longer time horizons and not really mandated. So you should always look. Your capital market strategy should have a combination of all these things. Which kind of a partner you get, how long you want to travel. The tenor is only growing longer, particularly I would say that the tenor is actually longer in non-IT. It's not like a 3 to 5 year exit, it's more like a 5 to 7 or a 10-year kind of an exit. So because scalability is not as much in case of a non-IT as much as it is in case of an IT. So from an investor perspective, there are investors who look at it because the fundamental theory is that if you play for long enough, you're committed to the game, you make as much money in any of the sectors, right? So then there is active management as to how you shift from one sector to the other sector, one subsector. So that's from the other side of the world, which is the investor world. But it bears a reflection on the entrepreneur as well, because one should understand that this is how an investor thinks. So you should understand that this is a very execution heavy business. It's not that, so it's for example not a knowledge driven business alone which can be scaled without any further investment. It's not asset light more frequently than not. Even if it is asset light, the scalability becomes an issue. So there are some fundamentals which makes the non-IT very different from an IT. So what are various funding options that one should look at? I think, well, it is debatable as to how governments are really committed to, how much is it translating into execution, but definitely the options are much more today than they were available in the previous years in terms of funding some of the early stage companies. So you should look at other alternatives besides the funds like that of ours, Ankur, SAFE, Omnivore, Rabo. I'm talking in the context of the agri investments. And of course, there are a lot of funds which are not necessarily IT driven. There's a lot of sector agnostic companies as well. And also, there's also, if there's a good amount of technology dimension or an IT dimension available in your what you're trying to do, and which you should try to do as a matter of fact, because that's where it is also you move in what is today's age. Today, right? Earlier, everything was a business. Today, they have graduated to be what is being called startups. So these are some of the things you should look at. I think I'm a little short on time, so I'll not take much of your time. So broadly speaking, I think from macro perspective, if GDP has to grow at a certain percentage, right, let's say 8% ambitiously, there are sectors which will move faster, they're higher, there are sectors which will move not so fast. But over time, if you look at it, all the sectors have to catch up. Today, IT is growing because the end use and end application at some point of time. Right? So I think, and not everybody is a geek, right? So there are entrepreneurs who are outside this, but it's very important for you to understand what kind of funding you should look at, because there's a lot of activity which is going on in IT sector today. That doesn't mean that there are no funders for what you're doing. Traditional funding is still available. Go the same route, family friends, followed by angels, followed and family offices, followed by then the private equity. One last good note is that companies which are non-IT are more IPO-able, which means the journey is obviously much longer. At some point of time, somebody has to figure this out. It's getting warmed up a bit now, but these have got as much potential to unlock value in the long run. I think it's pretty much the same. Thank you.
I remember paying substantial amounts for photography, not only for buying camera, for developing, printing, everything. Now it's for free. What has happened? Technology has demonetized that industry completely. Let's take another example, which almost everybody is influenced by. When we would do research, I remember it was a huge task to collect information about what's going on amongst the peer group. And a huge task meaning not only involving time, but also involving money. And the quality of information was not 360 degrees. You would be lucky to get bits and pieces. Today, I type on Google, 90% of what I want is available for free. So this is another example where things are getting, in some sense, demonetized. So I'll stretch the logic for you. Let's talk about the basic day-to-day activities that are influenced by technology. Food, transportation, housing, energy, healthcare, entertainment, education. If you look at the proportion of money that you spend on these, proportion of money, if you would earn 100 rupees, say 20 years ago, you would spend about 60 to 70 on these, food, housing, transportation, all of that. Today, that number has dramatically gone down, and it's likely to go down further. It's a different matter that per se, each item has become more expensive. That's a different matter. In the sense, tomatoes were 10 rupees a kilo, today they are 100 rupees a kilo, for example. But as a proportion of what you would spend on food has dramatically come down. So these businesses, transportation, everybody has heard of Uber. That's Uberization has become a reasonably well-known word. Tomorrow, when you have cars driven by themselves, and that's a reality, I'm sure you all have heard of it, the cost of owning a vehicle or cost of moving from one place to another is going to drop at least 5 to 10 times. What is likely to happen? Everybody is likely to get a commute which is driven by a chauffeur and not likely to be a human being. Every person. 20 years ago, mobile phones, when they came up, were a sign of affluence, sign of aspiration. We would pay for incoming as well as outgoing. Today, everybody has it. So that's the power of technology. So I leave you with 2 words. One is technology makes things simpler, and I don't foresee any sector that is not going to be touched by technology between now and next 5 years or 10 years. Everything is going to be affected by that. The second direction that I want to leave you with is most of these are going to be demonetized. It's a controversial word, but I still wanted to use it because it will stay with you. When I say demonetized, the likelihood of you using money for availing those facilities is going to go down dramatically. Okay, so I have covered 2 parts of the 3 words. Now comes to funding. Before I close, what I will do is I will read out a short verse which I had written at the same venue when, like today, I was impromptu asked to talk about funding. And I said, I don't have any presentation, why don't I write a small verse? They said, okay, that's fine, try your luck. If it goes well with the audience, let's see. So the 3rd word about this topic is funding, and I'm going to recite a few lines for you. Okay. Funding is more ding and less fun. Trust me, some of us are here from the financing industry. It's definitely not fun. Though boring, it enables businesses run. Debt and equity are its only 2 forms, or their mix based on some norms. Fun is mixing these into some heady ale. Risk and opportunity cost add to this cocktail. Debt is more disciplined. Debt is more disciplined of the 2. Assured cash and specific timing too. Equity is more bubbly. Neither specified returns nor timing too. Stable businesses attract debt with swagger. Others find debt as much a risky dagger. Funding is trust. Mind this. When we talk about funding, it's all about future and it's all about trust. I trust you, I fund you. Your customers trust you, they buy your good for future. Funding is trust in future or simply trust. Else, money has no meaning, it will simply rust. Innovation is in enhancing collective trust. Funding is a mere lubricant or an anti-rust. Innovation is smooth funding from one and all. The models of funding from a big banker to a small entrepreneur are going to go away. There will be variety sources of funding, angel, venture capital, crowd, all of it. What's the end game? Innovation is smooth and funding from one and all to all. Welcome to this roller coaster. Have a great ball. Thank you so much.
Thank you, Sanjay. And now I understand being the advantages if you are an author. Okay. Now I would like to introduce Indu Shekhar. He's currently with Chief Marketing Officer of Asianet News, which runs, as you know, many of the big channels. One thing I have noticed in his bio is he's an advisor on investment in the media sector, hospitality and technology. Again, the technology is coming in, even though we are speaking about non-IT. Over to Indu Chandrasekhar.
So I think Sanjay and I, we had the same dilemma of, is this going to be a panel discussion where we could just shoot our mouth based on the topic in currency, or was it going to be a speaking slot? But hopefully it ended up being so as a speaking slot, so no poetry to narrate, but some context in terms of what it is from an experience perspective. Almost a decade ago, right, when you talked IT, there was a large conversation that talked about IT becoming a utility, right? People, and which is exactly what was getting narrated out here, because it doesn't stand out in itself. But then if you're talking about startup, if you're talking about funding in non-IT sectors, so my dissection of that would primarily be about sectors that don't use so much of technology, if you will. So you're talking about, you know, which don't depend on technology in toto. Of course, you know, today, even if you're shipping one product from one place to another, it goes through a certain supply chain, logistics pipeline, where there is technology intervention and all that. But then if you assume that IT is a utility and you talk about the topic of funding in non-IT sectors, you're referring to sectors that don't use IT as an input, if you will. So I'll go a bit in that direction, if you will. And it's even more interesting because non-IT sectors are a little removed from the smoke screen that IT sectors throw up there, right? The smoke screen of valuation, the smoke screen of hypergrowth, the smoke screen of, you know, future growth in many of those dimensions, right? In a non-IT sector, you've got some of those very fundamental principles that apply, which means that you are a pathetic businessman if you are making a loss. But many of the companies that run on technology and IT, if you will, have 1,000, 2,000 crore losses lined up, right? So from that perspective, the non-IT sectors respect a little more in terms of the fundamentals of business building, if you will. So funding non-IT sectors will ultimately be a tad more prudent for an investor, though we are talking about, you know, much of the Silicon Valley where it started off and rest of it. So some of the investments that I've worked with have been largely in the media tech spaces, so like Sanjay was talking about. And out there are very clear matrices to kind of evaluate growth, and there are also smoke screens which kind of exist in terms of future growth. In media tech, for instance, you're talking about building user bases, potentially, you know, we heard about buyouts, preparing an organization for buyouts or stake come-ins and things like that. IT sectors typically have a lot of metrics that you can chase, but the non-IT sectors work on the very fundamental of business building, which is a P&L, which talks about, are you making money in every investment? Are you building your customer base? Are you capturing new markets? And some of that. So taking a step back, funding in non-IT sectors, I would imagine, is a little more challenging because it is not easy to put in perspectives and hyper growth points out there, right? So if Pepperfry, which we heard this morning, that fantastic presentation, were to be in a non-IT space, if it were to be a non-e-com player, would it have grown 12-fold into its third year, right? But then, on another respect, it could be a biryani joint or something else. Somebody who's, you know, I was talking to Hari, who's doing something in the cashinet space, or any of those traditionally non-IT spaces, then there is a critical articulation to actually show that you will need to kind of invest that in. So again, from a fund investment perspective, the non-IT sectors demand a little more inflow because for growth, you will need growth capital that is of a very different direction altogether, right? So
either you need growth capital to support your inventory, not so much about technology, because on the other side, technology is also sometimes a money guzzler, right? I mean, you start investing in platforms. Again, it depends. Are you using technology as a platform, or are you using technology as an enabler, right? I mean, a lot of IT sectors, if you will, or IT-driven companies use technology as a platform unto itself, right? It could be medical, it could be healthcare, it could be pharma, it could be retail, it could be hospitality or whatever, right? It could be travel, any of that. But then there is a different dimension that goes into the whole thing. And the other piece is also about, I think one of the things that people don't talk about it so much is the challenge, and which I find in the overall environment very challenged, at least from a startups ecosystem perspective, is compliance. I feel that a lot of the non-IT, the IT-driven companies are hugely vulnerable to compliance, are hugely vulnerable to data breaches, are hugely vulnerable to downtimes, if you will. So a few system crashes, a few ransomware attacks, and the entire ecosystem can keep crumbling down.
My question is, when VCs invest into a company, what kind of returns do they look in? Maybe when exiting at 3 or 5 years down the line.
See, typically, any VC, the way we pick up mandates because we manage funds is typically in the range of about 25%, okay, from an IRR perspective. But I'm just giving a broader thumb rule for you. It's also, we can go back and trace why it's 25, why not 40, why not 30 is a different thing. But I think we had a session today morning on the valuation, right? So where you eventually end up in terms of valuation is a different story, right? So you can't really apply that IRR and discount your, there's a lot of questions about your projections. But if you're talking about an early stage company, I think even from your business, your own perspective, right? So you should be making as much money as an entrepreneur from that perspective, given what is the alternative opportunity cost of the funds and your time and the risk that you're taking. And somebody who is coming early stage on, like for example, somebody was asking the question some while back that what are various kinds of funding, right? So if for example, a bank is funding about 1 crore under CGT SME, or there's a venture fund or there's a venture debt fund which is putting $1 million against a backdrop of a seemingly capital intensive business. That means if the entrepreneur has put in, let's say, 1 crore of rupees and going for a fundraise of about $1 million, that means obviously there is a certain stake and returns which are fairly expected from an investor. But I think your question becomes relevant in terms of where does the valuation end. So there's a lot of subjectivity. What you should understand is there's a lot of subjectivity when you apply this question, this answer of yours, and when you go to an investor and actually initiate a conversation and come to that level, as to where you apply, what kind of return you give. But typically speaking, I think, but in very early stage, to be fair, though it is put as 25%, the expectation is higher because the return, because the risk is much higher. It also depends, it's very case to case. Suppose you have invested already 20 crores, and if you're going for another 20 crores after building business to a certain extent, I think you should, I mean, you can actually apply the 25% principle, and very subjective. But I've given a thumb rule, I guess.
Can I have one last question? After that, the panelists will be available offline.
Yeah, we're talking about the return expectations for venture capital. What would be the return expectations for venture debt?
Again, from I mean, from our perspective, it would be sort of, you know, in the 20-22% range. And I think fundamentally it depends on the stage of the company, right? Because when we are talking about venture debt, we do see companies at fairly different stages, right? But I would think that whatever we've heard in the market also, you would tend to not see anything less than, say, 15-16%. It may be closer to, you know, a little above that as well. I think the other thing to keep in mind over here is that there could be different kind of structures, right? Including whether these are, convertibles, and therefore the cost of debt itself may partly reflect the various optionalities there. But you need to start with the assumption that it would be probably at least 4-5 percentage points more than what you would have to pay to a bank, right? But the reality is that you're not going to get that credit from the bank, or certainly not to the extent that you need. I hope I've given some context to it.
I have a last question to Indushekar. When you make media investments, typically my question may be a little sensitive. Your investment into one of the latest channels, everybody knows the channel. What was your sort of intention, or how did you make the decision? You know the channel I am referring about.
I think, so I'll give you a very broad-based perspective, right? It's all about, there has to be the person who's leading the entire investment, ask, if you will. And oftentimes investors invest into individuals and investments, right? And individuals first. So certainly the individual had significant reckoning, and the kind of achievements that he's demonstrating out there in terms of the marketplace, in terms of the kind of GRPs that he's achieving and stuff like that is proof of that. So that's the most fundamental point to it. And then of course there would have been a bunch of, though I didn't sit on the investment board that analyzed that, but then there would have obviously been a bunch of perspectives around the success factor and the conversion and some of those pieces around it. So basically I think the interesting part is that it's a crowded space. The media space is a crowded space. But then in a crowded space, there was somebody who was a phenomenon unto himself. It's a point of view in terms of which side of the spectrum you're in. But then that in itself gives it credence to be attempted, and that was the model.
Thank you. Thank you, panelists. Thank you, the audience.